Hello everyone. As we do at the beginning of each quarter, we are going to share with you the main insights that can be extracted from our digital top-down methodology. Our approach consists of assessing the attractiveness of European equities based on 4 complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. This is still in the recovery phase that began barely a year ago. However, the global economy is showing signs of slowdown. China is disappointing, and the risk of recession is rising in the United States. The good news is that this is being deliberately triggered by very aggressive monetary policies designed to tackle inflation. It would therefore come as no surprise to see a shift in central bank priorities and a return to accommodative policies in support of the economy, especially as inflation is on its way down. The second pillar deals with the ECB's monetary policy. The recent 25 basis point hike in policy rates in September is likely to be the last in the cycle of rate hikes that began in July 2022. However, the US Fed sowed doubts in September with its highly restrictive rhetoric. However, communication is now an integral part of monetary policy, and it's unlikely that this will lead to action and a new rate hike cycle. The third pillar of our analysis relates to valuations. The risk premium of the European equity market remains attractive by historical standards. At the end of September, the PE of the Stoxx Europe 600 index reached 12.2, a 13% discount to the average since year 2000. A gloomy macro scenario is already priced in. Last but not least, the earnings revision momentum has remained on the rise since last spring, with the third quarter earnings releases just around the corner. Finally, the fourth pillar deals with the behavioral aspect. At the start of this quarter, European, American and global indices are testing the key level of the 200-day moving average. There's no doubt that this test will set the tone for the fourth quarter, which is traditionally the best stock market period of the year. The current environment is leaving many investors confused, especially since a succession of negative news items dominated the headlines at the end of quarter 3. Rising oil prices, the restrictive tone of central banks, Chinese economy in the doldrums. However, economic momentum remains robust according to Cheyne Capital's proprietary indicators, and central banks may soon shift their focus back to supporting growth, even if it's still a little early to announce it. Such a shift, which is our central scenario, would be a powerful support for the equity asset class at a time when valuations are low and we are testing key supports on all the major international indices at the start of the fourth quarter. Thank you, and see you next quarter for a new video by Shaheen Capital.